afternoon, everybody. This is the day after the big day, the budget day, and as I looked from my wall of prime ministers past, who've all had their contribution to where we are at this current point, there can seldom have been a more sensational budget presentation and attack on the budget presentation than we had yesterday. We've identified what we think are the five major issues in the budget that might affect you. Essentially, the budget was not cutting costs, it was increasing costs, and there have been £26 billion worth of tax rises. This makes it the most taxed that we have ever been in this country for a long, long time. And that is the general equalisation attempt of what Rachel Reeves is trying to attempt to do it. She's introducing a mansion tax. So the mansion tax will initially operate on houses worth more than 2 million and up to 7.5 million. Your additional mansion tax will be somewhere between 2,500 and 7,500. ATED, which is the annual taxation on enveloped dwellings, started at 2 million and then went down to 1 million and then went down to 500,000. If it goes down to 500,000, there will be an awful lot of people paying extra tax for their house. If you can't pay it for cash flow reasons, you can roll it up, and when you pass away, then it comes out of your estate, or if you sell the house, you have to pay it then. There's a £2,000 cap on salary sacrifice pension contributions. Everything over and above that will be taxable and NICable, so employers will have 15% employers' national insurance to pay on top of anything over and above £2,000. Electric cars, they've been hit, 3p per mile for pure electric cars, 1.5p per mile for hybrid cars, and yes, that does include the element that was petrol usage, and yes, it does involve any element that you incurred mileage in another country. So it will be collected in some form of linkage to the MOT. The main thing about this budget, Rachel Reeves has increased the time zone for fiscal drag. The Conservatives had bans frozen and were agreed to be frozen until 2028. Well, Rachel Reeves has extended that by 3 years to 2031. If your pay goes up on an incremental basis with inflation, or if you get a pay rise, then more and more people are going to be paying tax at a higher rate. The removal of the two-child cap benefit has created a lot of extra costs, which will happen pretty much now, and the payment of those costs is going to be in the future. So there is an issue there of, is it going to solve our debt problems? Probably not initially. The wealthier people are the people who are being looked at to provide the extra taxation to fund the increase in costs. With regards to business, one of the main issues is the increase in the national minimum living wage, which has a knock-on effect. Everyone who else is employed is going to want the same differential between those people and themselves. So effectively, every single person in the organisation is going to want a pay review. Employers have three choices. They either put their prices up, which is essentially inflation, is not very popular with the public, or they employ fewer people, or they don't give pay rises. None of those are popular, and you will note that the unemployment rate has chipped up as a result of some of those policies. So the other major thing, having said that taxes would not be increased, is an additional 2p at all rates. So 20% becomes 22, 40% becomes 42, and 45% becomes 47 on investment income, dividends and rental income. So if you have a rental portfolio, you will be paying 2p more tax in the pound than you are at the moment. If you receive dividends, the rate of dividend tax for a basic rate taxpayer is going up from 8.75% to 10.75%, which makes directors stroke shareholders of companies, they are getting taxed more for essentially running and owning their own company. So it's a hit on people who have spent their life frugally and have saved money and are now looking to live on their investments during their retirement, and they are now having to pay more tax on their investment income, which, as you can probably imagine, means that if it's a rental income, they're going to put their rents up to cover their additional costs. So rents will go up. So in summary, this budget has offered a lot with regards to increasing benefits and increasing general giveaways, and the people who are paying for that are investors, people who receive dividends, people who receive rental income, and people whose pay reviews and the affluction of time takes them into a new tax bracket.